Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel Accounting Buddy. In part 1 of chapter 3, we explored various accounting concepts and assumptions with examples. We also familiarized ourselves with the terms GAAP and IFRS. Through the accounting assumption of consistency, we learned about two methods of charging depreciation on fixed assets. In today's video, we will engage into several key accounting principles that serve as the guiding rules for the accounting field. You don't want to miss this. So sit back, relax, and watch attentively. The video will provide you with ready to use exam notes followed by question and answer session at the end. Accounting principles are the basic guidelines and rules that accountants follow universally for recording accounting transactions. These set of guiding rules ensure consistency in the preparation of financial statements. Accounting rules makes financial statements more reliable for the stakeholders, and it also makes different period financial statements comparable. Few examples of accounting guidelines which are followed by all the accountants are: stock or inventory is always valued at cost or net realizable value, whichever is less. I hope you remember this concept which we learned with example in our previous lessons. Another accounting guideline which is always followed is that fixed assets are depreciated over their expected life and not in the year in which they are purchased. Assets are always recorded at their original purchase cost is another accounting guideline which is followed universally. Therefore, we can say that when set of accounting principles are consistently and uniformly followed, user is in a better position to understand the financial statements for decision making. It also means since all the businesses follow same accounting principles, the comparison of financial statements becomes much more easier and meaningful. Business entity principle is one of the most important accounting principles. Business is considered separate from its owners. In other words, business is considered as a separate legal entity which is different from the entity of its owners. This means business owners should keep business and personal records separate. This principle ensures that information only related to business is recorded and thus accurate profit or loss is reported for tax purposes. The tax department is concerned only with the business related transactions. Business entity concept is applied to every type of business, whether it is sole proprietorship, partnership, or a company. This principle ensures that financial statements reflects true performance of the business. Since under this principle owners are separate from business, the amount contributed by them as capital in the business is considered as the money which the business owes to them. Transactions between the owner and the business are tracked in a separate account that is called owner's account, which is also called owner's equity. It is credited with the amount of capital contributed and the profit earned. It is debited with the amount of drawings and the losses incurred during the accounting period. Next accounting principle which we are going to learn is the principle of money measurement. According to this principle, only those business transactions and events that can be measured in monetary terms are recorded in the accounting books. Since all transactions are quantifiable in monetary terms, it ensures consistency and comparability of financial reports. This principle implies that focus of accounting transactions is only on quantitative information and not on qualitative information. Therefore, transactions and events which cannot be measured in monetary terms are not recorded in the books of accounts even if they are of great importance to the business. Few examples of items which are related to business but cannot be recorded in the books of accounts are human resources, machine breakdown impact on business, value of in-house brands. Please note that the business transactions are recorded at the value on the date of its transaction. They are continued to be shown on the recorded value and current market values are ignored. We have discussed the term accounting period several times in our previous videos. Accounts of any business are maintained following the going concern concept. I hope that you remember the concept of going concerns. Yes, it means that the business will continue to operate for a foreseeable future. In order to measure the financial performance of the business regularly, a span of 12-month period is called an accounting period. Now, a period of 12 months could be Jan to December or April to March or even July to June. Period of 12 months for which financial statements are prepared is also referred to as fiscal year. The principle allows the business to divide their operations into time periods, usually 12 months, so that the business performance and business financial position can be assessed systematically. This 12-month period information is required by the internal and external stakeholders for decision making. Therefore, financial information for an accounting period of 12 months is required by management to assess the business performance and take actions accordingly, by the banks who have lended the money to the business and need to ensure the safe repayment of interest and loan, by the income tax department to assess the tax liability of the business. For every accounting period of 12 months, financial statements, that is profit and loss account, balance sheet and cash flow for the business are prepared. As per full disclosure principle, all the relevant financial information should be disclosed in the financial statements. This concept suggests that the business should report all the necessary information in their financial statements so that the reader of the financial statements is in a better position to make important decisions regarding the business. This principle ensures complete transparency by providing all the relevant and necessary information to the stakeholders to make informed decisions. Apart from statutory requirements, good accounting practice requires all the material and significant information about the business to be disclosed in the financial statements. Disclosure of material information will result in a better understanding of the current business performance and its future impact, if any. Now, the question is what to disclose. Some of the important disclosures could be change in accounting principles or policies. I hope you remember the concept of consistency, wherein we learned if the accounting method is once adopted, it should be followed year after year. Now, the full disclosure principle states that if any change is made in the principle or the policies adopted, it should be disclosed along with its impact in the financial statements. Another example could be how the business is recognizing its revenue. Next is how inventory is valued, or how the assets are depreciated, or if there is any change in the ownership, or what are the plans for the expansion of the business, or any other relevant information. Any information that can impact the decision of the user is a relevant information. As per materiality principle, all the material items must be reported in the financial statements. All the material information that could influence the decision making of the user should be disclosed in the financial statements. Now, whether an item is material or not depends on its nature and amount involved. The threshold for materiality varies depending on the size and the nature of the business. Therefore, immaterial or insignificant items can either be aggregated or disregarded. Therefore, it is a matter of exercising some judgment to decide which item is material and which is not. Let us understand materiality principle with an example. In scenario 1, sales of the business is INR 500 million and the customer default payment of INR 1000. Now in this example, default of INR 1000 is not a significant event for a business having a sales of INR 500 million. In scenario number 2, if the customer default in payment is amounting to INR 20 million, now in this scenario it is a significant matter and needs to be disclosed in the financial statements as it is going to have a severe impact on the financial position of the business. In example 2, where the manufacturing of a business was stopped even temporarily due to labor strike, is a material event and this definitely needs a disclosure. The principle of prudence says provide for all anticipated losses and expenses of the business, but do not account anticipated income and profits. This principle ensures that the assets and income are not overstated and liabilities and expenses are not understated. Under this principle of prudence, the accountants are required to act with care and thus ensures that financial statements do not mislead the stakeholders by being overly optimistic. Therefore, conservative principle ensures that the assets and liabilities and expenses and losses are correctly stated in the financial statements so to ensure that the profits are not overstated and losses are not understated. Let us take an example. We have learned that stock is valued at cost or net realizable value, whichever is less. Now, if the accounting year is Jan to December and the closing inventory as on the last day, that is 31st December 23 of the accounting period 2023 is 2000 quantity and the cost per item is 50. Therefore, the value of stock at historical cost will be INR 100,000. In January 24, the same item was sold at INR 48 per item. Therefore, as per prudence principle, the inventory in this case will be valued at 48 INR per item and the total value of inventory will be INR 96,000 and not INR 100,000. By applying prudence principle, business in this example will book an anticipated loss of INR 4,000 and the stock value of INR 96,000 will appear in the balance sheet. Now imagine even after knowing that the item can only be sold at INR 48, if the business do not have acted, it would have resulted into overstatement of profit by 4,000 and overstatement of assets by INR 4,000. I hope you remember the term historical cost. Yes, absolutely. We learned about this term when we discussed fixed assets. Under historical cost principle, assets are always recorded and reported at their original purchase cost, and this historical cost is the basis for all the subsequent accounting of that asset. Since historical cost is backed up by documentary evidence, that is the supplier invoice, thus this principle ensures to provide reliable and verifiable basis of financial reporting. Please remember, current market value of the asset is never considered. Fixed assets are always recorded at cost paid at the time of its purchase and this original cost is reduced every year by the amount of depreciation. I hope you remember the terms fixed asset, depreciation, and various methods of charging depreciation. Historical cost is static and does not change even if the value of the assets appreciate. Now, the table displayed on your screen shows the purchase cost of an asset, and the original cost is getting reduced by the amount of depreciation charged every year. As per matching principle, business expenses should match with the business revenue they help to generate within the same accounting period. This concept is important and ensures that the true and accurate profit earned or loss incurred for a business is measured and reported. Thus, this principle ensures the relevance and reliability of financial statements. It is a basic logic. If the business considers and deducts all the expenses incurred to generate the revenue for a specific accounting period, then only accurate profit or loss of the business can be determined. Let us understand this principle with an example. A business pays annual bonus to its staff, say at the rate of 5% of annual sales, and the bonus is paid in the month of February of the following year. Now, if the accounting year is Jan to December and the sales for financial year 23 is INR 100 million, the total bonus payable at the rate of 5% for the financial year 23 will be INR 5 million, and this will be paid in the month of February 24. Now this bonus of INR 5 million will be considered for calculating the profit for the financial year 23. Hope you know why. Yes, because INR 5 million bonus is also incurred to generate the revenue of INR 100 million. INR 5 million will be shown as liability in the balance sheet as it is not paid. Therefore, always remember all the revenue earned should always be matched with the expenses incurred to earn those revenues. Let us now answer few questions related to accounting principles which we have learned in today's video. Question number 1. Which accounting principle states that business is separate from its owners? The answer is business entity principle. Question number 2. Under which principle quality of manpower is not recorded in the books of accounts of a business? The answer is money measurement principle. Question number 3. Which accounting principle requires that the life of a business be broken into smaller parts? The answer is accounting period principle. Question number 4. Under which concept asset is recorded at cost even if the market price is more or less? The answer is cost concept. Question number 5. What is depreciation? The answer is depreciation is the allocation of the cost of a fixed asset over its useful life. Question number 6. Under which concept sales is recorded even if the customer has promised to pay after 90 days? The answer is revenue recognition concept. Question number 7 on your screens is under which accounting principle stock in hand is valued at lower of cost or net realizable value? The answer is prudence principle. Question number 8. If the office rent for the month of January 24 is paid in July 24, under which concept the office rent will still be booked as expense in the month of January 24? The answer is accrual concept. Question number 9. Explain historical cost principle. The answer is as per historical cost principle, assets are recorded in the books of accounts at the price paid to acquire them. Historical cost is the basis of all the subsequent transactions related to that asset. In our next video on 2nd November, we will discuss remaining 3 accounting principles including the very important principle of revenue recognition. We will also cover introduction to accounting standards and their objectives, together with their global relevance. If you like the content of our channel and our way of explaining the topics, please like, comment and subscribe to our channel Accounting Buddy. Please do not forget to press the bell icon so that you do not miss our latest posts. Thank you and goodbye.